and welcome to Q2FY23 earnings conference call of CreditAccess Grameen Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you, and over to you.
Yeah, hi. Thanks, Yashashri. Hello and good evening, everyone. Welcome to the CreditAccess Grameen Q2FY23 earnings conference call. From the management team, we have with us today Mr. Uday Kumar Hebbar, MD and CEO, Mr. Ganesh Narayan, Deputy CEO and Chief Business Officer, Mr. Balakrishna Kamath, CFO, and Mr. Nilesh Dalvi, SVP and Head Investor Relations. We will start the call with brief opening remarks and then open the call for Q&A. I would like to thank the management team for giving us the opportunity to host the Q2FY23 earnings call. I will now hand over the call to Mr. Uday sir for opening remarks. Over to you, sir.
Thank you, Renish. Good evening to everyone, and thanks for joining this conference call. We welcome you all to discuss our second quarter and first half FY23 financial performance. We would like to say with great confidence that we are well placed to deliver robust growth and profitability, which would further strengthen our leadership position over the coming quarters and years. We have witnessed the strongest second quarter performance to date, with all-round improvement across all key parameters ranging from borrower addition, disbursement, collection efficiency, asset quality, net interest margin, return ratios, and traction in foreign funding. We are among the early adopters of new microfinance guidelines, which helped us to channelize our energy towards customer additions and loan renewals during the second quarter. At a consolidated level, we added over 2.8 lakh borrowers during Q2 FY23, the highest borrower addition witnessed in the second quarter. Our borrower base grew by 3% QOQ and 5.7% YOY on a pre-rate of base. 3% QOQ and 5.7% on a pre-rate of base to reach nearly 38 lakh now. At CA Grameen, our borrower base grew by 8.8% YOY and 15.5% YOY on pre-rate of basis to reach nearly 30 lakh. At MFL, and there was 20.6% YOY degrowth in the borrower base, the period of basis we had grown by 8.2%. On a consolidated basis, we added 8.8 lakh new borrowers over last 12 months, with 47% coming from outside of top 3 states. Our consolidated gross loan portfolio grew by 24% YOY and 5.9% QOQ to rupees 16,539 crore. On period of basis, the growth stands at 25.3%. The second quarter disbursement at 4,375 crore at 12.5% YOY growth are highest ever. We appreciate the effort of our MFL field staff who are currently managing 2 interfaces, given that 8% of the book is on CA Grameen Tech platform and the remaining 16% book on MFL Tech platform, and still be able to deliver the growth. The branch addition remained largely muted during the second quarter as we decided to focus on unlocking branch level productivity. In the last 3.5 years, we have opened over 525 branches at a consolidated level where business couldn't scale owing to COVID-related disruptions. With COVID waning away and the industry being at the new phase, we expect to generate significant business from these branches, which will be further visible in various productivity-related indicators. We will reinitiate the branch expansions in the second half as per our plan. Our collection efficiency and asset quality have now largely normalized. Consolidated collection efficiency during Q2 FY23 stood at 97%, excluding arrears, and 98% including arrears. GNPA, largely 60 plus DPD, reduced from 3.11% in June 22 to 2.1% in September 22. PAR 90 reduced from 2.33% in June 22 to 1.72 in September 22, and net NPA 60 DPD reduced from 1.15% in June 22 to 0.77% in September 22. We are best placed to protect our NIMs in a rising interest scenario with strong control over cost of borrowings coupled with one of the lowest lending rates in the industry. Our consolidated weighted average cost of borrowing was at 9.2% during Q2 FY23, only 30 bps higher compared to Q4 FY22. That means in the last 6 months. CA Grameen's marginal cost of borrowing during Q2 FY22 was 8.8%, so 50 bps higher in the last 6 months. Our NIM was 12% in Q2 FY23 and 11.4 during HY FY23. This is 50 bps higher compared to 10.9% in FY22. As guided earlier, we anticipate our NIMs to improve in FY23 driven by new loan pricing, low interest recognition and lower liquidity carrying cost. On a consolidated basis, NII grew by 39.9% YOY to rupees 516 crores, while PPOP grew by 52.1% YOY to rupees 334 crores, indicating a clear path of strong profitability growth ahead. The credit cost was 105 crores, which also included the impact of the write-off of rupees 163 crores. This was partially offset by rupees 14.5 crores of bad debt recovery during the second quarter. Overall, ECL stood at 2.46% at the end of Q2 FY23, higher than our GNPA. We recorded our highest quarterly consolidated PAT of rupees 176 crore during Q2 FY23, despite it being a seasonally moderate quarter, resulting in a ROE of 4% and ROE of 16.1%. Overall, looking at our H1 FY23 financial performance, we are hungry about achieving our annual performance guidance for FY23. Our liability franchise is an important pillar to achieving the desirable scale under the microfinance avatar and providing affordable products to our clientele. We saw several positive developments on the liability front during the financial year. In Q1 FY23, India Rating upgraded our rating from A+ stable to AA- stable, and ICRA upgraded our rating outlook from A stable to A+ stable to A+ positive. This was followed by CRISIL upgrading our rating outlook to A+ positive from A+ stable in Q2 FY23. We are witnessing a strong traction in foreign fund flows, aiding our strategy of diversifying our liability mix and achieving 25 to 30% foreign funding over the medium term. During this financial year, we have received sanctions around $195 million from prominent foreign financial institutions and government bodies, including Blue Orchard International Finance Corporation, syndicated loan by HSBC, and United States International Development Finance Corporation. Today, we have strong visibility of foreign sourcing, backed by a 38% share in undrawn sanctions and 19% share in sanction in pipeline. And we have a strong policy that we will not have any open position and 100% foreign currency hedging coverage, so that we are not exposed to any hedging risk or currency risk. We are extremely happy to announce that BFC supported us with $35 million ESG-backed ESG-linked loan for up to 7 years, and it is the first of its kind direct lending by them to an Indian MFI. This is our second ESG-linked loan after receiving the first ESG loan sanction, $25 million from SWED in July 21. The microfinance model fits well under ESG realm, given global investors are actively looking at funding ESG compliant businesses. We aim to tap ESG funds in our journey, which have seen a lot of traction and making concrete efforts to achieve the same, ranging from commencing integrated reporting beginning since FY21 and formulating various policies in the environmental, social and governance framework which are available in the public domain, top of our website. We would also like to inform you that we are in the process of launching our maiden public NCD issue in the month of November 22. We have already filed draft shelf prospectus available on SEBI website for reference. We are planning to raise up to rupees 1,500 crores in multiple tranches over coming year. This issue will be the first public NCD issue to be launched by any NBFC MFI. We have earlier raised rupees 210 crores through market-linked debentures at a competitive rate and have witnessed good response from HNIs and family officers. We are taking this route to further diversify our liability profile and establish a strong source of funds through public markets which can be tapped in future. Our IT system has giving us relentless support to cover a wider and deeper footprint. I'm happy to inform you that CA Grameen has bagged the Best Technology of the Year 22 award in the financial service category at Quantic India Technology Excellence Awards. The award was bestowed for adopting effective measures to drive technological advancement, scalable infrastructure, and enabling the best-in-class applications. Given technological adoption is critical in the quest for enhanced productivity and gaining the competitive edge. We would like to open the forum for a question and answer session. Thank you for your patience hearing.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Shripal Doshi from Equirus. Please go ahead.
Hello, sir. A very good evening, and thank you for giving me the opportunity. So the question was with respect to the portfolio yield. So what are the increases that we have taken over the last 2 quarters in our yields?
See, based on the new guidelines where interest can be priced actually based on your cost of borrowing, cost of capital, cost of operation, and cost of risk. So our yield would have gone up by the futuristic disbursement, gone up by almost 1.3%. Okay, so which basically makes about 11.3% interest yield, along with other incomes and processes together. We aim at about 20% NIM here onwards. The entire full benefit we would get by within 2 years' time, but yeah, some benefit we'll start getting here onwards.
Sir, I'm sorry I didn't get. So you said NIM would inch up to 11%?
12%.
12%, okay. And the portfolio yield has gone up to 21%, is it?
It is around 19% odd now. It will actually, with the full benefit of 2 years, it should actually hover around 20.3% end of thing.
Okay, got it, sir. And sir, you highlighted that on the liability side, we are looking at newer avenues. So what is the kind of mix that we are looking at over the next, say, 2 years? Because I suppose even on the asset side, we have increased our product tenure for our vintage customers. So on the liability side, what is the kind of changes that we are looking at in terms of mix? If you could answer that.
So I think I have already answered in the opening remarks. Our view is that to enhance our liability profile by at least 25 to 30% from international sources, which will be stable and long term. So which will help us to have a positive ALM, which already we are, which will further enhance. That is one step. Second, we said we also are working towards raising about 1,500 crores through public NCD, which will be again a long-term funding resources, which will make us more than 50% of our funds eventually in maybe medium-term level are more than 3 years loans, which will automatically strengthen the liability profile.
Okay. Got it, sir. Got it. And sir, just one last question on the loan officer side. So I suppose the last quarter, this 2Q, we have added 700, 800 odd loan officers. So what is the number of borrowers and AUM per loan officer that we feel that we would be comfortable with in terms of operational metric?
See, in our case, we always look at relationship as key parameter. Therefore, we don't want to load too much on our loan officers. If the loan officer is number of customers are higher to loan officers, the relationship building will not be possible. Therefore, we are comfortable at about 400 to 450 customers per loan officers only.
And got it. So so what is it? If you could just throw some color.
Annually, we revise our ECL policy to review what is forgone last year and what more we have to do. So the new what you call risks which is appearing in the different places considering last 2 years or last 3-4 years. So accordingly, what we designed the policy is to have a different PD and LGD based on the geographic risk. It's not just a common PD LGD across the board. So therefore, there is a the states are designed into low risk, medium risk, and high risk category, and the PD and LGD also revised based on such risks. So instead of a common PD LGD for the entire book, it is more on risk. So that we can arrive with a better ECL provision. So also giving a color of little what you call macro level GDP impact, if anything is there, then again we can look at that also as additional parameter. So we added a couple of such parameters to refine better than what we had earlier, which increased our ECL by about 15 bits.
Hello?
Hello?
Yes, sir. I can hear you.
Okay. So I told which actually increased our, on a comparative basis, our ECL has gone up by about 15 bits with the revised ECL process.
Got it, sir. Thank you so much for that detailed answer. And sir, happy Diwali to the entire team in advance. Thank you.
Thank you. Same to you all.
Thank you. Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Pooja Ahuja from Monarch Networth Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on the quarter, sir.
Sorry, but there's some echo coming from your line. Can you use the handset, please?
Yeah. Is this better?
Yes, please go ahead.
Yes.
Yeah. So congrats on the quarter. So firstly, wanted to understand on the cost of funds front, while you've seen improvement this quarter, would you largely attribute to the liquidity rundown? And what are our incremental cost of funds?
No, incremental cost of funds I explained. Our marginal cost increased by 50 bits in the last 6 months, and average cost of borrowing increased by 30 bits in this last 6 months.
Right, but QOQ we've seen some improvement. So would you attribute that to because you've seen some liquidity rundown?
No. There's no relation with the liquidity rundown for this, because we also raised almost 3,000 crores during the quarter, and it's more of a liability management. Borrowing with the right pacing and right maturity. So I think that's what paid out actually. Liquidity management rundown will not have an impact on the cost of borrowing.
Okay, sure, sir. And secondly, on the retail book, that's not seen traction in the past 2 quarters. So just wanted to understand while we were running other products on pilot basis, when do we see those segments sort of meaningfully contributing to our book?
We already said earlier also, this year we will do more of pilots. You won't see numbers actually, because we want to do what we are picking up it should be right model. So number traction will be in the next financial year. So we are doing more of a pilot this year.
Okay, sure. That's it from mine, sir. Thank you and happy Diwali to the team.
Thank you and happy Diwali to you all.
Thank you. We have our next question from the line of Abhishek Murarka from HSBC. Please go ahead.
Hi, sir. Good evening, and congratulations for the quarter. Few questions.
Thank you.
One on branches. You said in the second half you would sort of reinitiate branch addition. What kind of run rate are you looking at?
So it's a normal run rate, what we want to do, about 10 to 12% of our base. That is what we normally do. And earlier, normally we used to do in the first half. But what we thought that it would be better to use the current, focus now and mature the branches which we have opened in the early last 3.5 years. Very large number of branches which not as matured. We have a lot of scope lot of headroom there in both branches. So we thought to focus couple of months actually to improve them and reinitiate during the year. So the 10 to 12% of the base increment, and then we will be doing the same level this year also.
By the end of the year, you would be 10 to 12% higher in branch count versus beginning of the year. That's what you're trying to say.
Exactly. Yes,
Right.
Absolutely.
And so, just on these branches, so if I calculate even now, you would be at around 350 customers per loan officer, and your comfort level is 400 to 450. So you have at least 15 to 30% extra capacity in the system already. So
correct.
would it not be useful to push out this branch and people addition and sweat the existing branches and people, at least for a while before you start adding?
No,
improve the efficiencies, basically.
That is looking at the current, and we need to look for the future also. We need to create infrastructure for next year also, Abhishek. So
Right.
if you keep doing it, then when you start, then actually you don't have headroom afterwards. So we need to keep creating the branches for the future growth. The only way is create branches this year and get the potential business next 2-3 years. So I think that's why we will not compromise on expansion of the branches.
Okay, so suffice to say then you would probably remain in this 350 to 400 space, because every time you hit that 400, by that time your fresh capacity will come up.
So there will be, when we say average, it need not be average across the branches, but where we in a mature branch will have about 450, 500, and the non-mature branch will have a lesser. That kind of combination will be there always.
Understood, sir. Understood. The other question is on NIM expansion. Actually, I think if I remember correctly, you had guided for a 70 bip NIM expansion over 2 years or something of that order. And we've seen a sudden expansion already. And, there's more pricing benefit yet to come. I think almost 60% of your book will move to the new pricing methodology. So, do you think, from here, how much, further NIM expansion do you envisage, or do you think your cost of funds would finally start catching up and you would limit the NIMs would get limited to a certain level?
No, we guided the margin expansion by 1.3%, and we said that 50 to 70 bits may come in the first financial year. The balance will be the next financial year. That's what we said. And then here the expansion is almost 90 bits. This is a combination of two things. One is the NIM expansion because of interest rate. Second was because of the lesser derecognition. Third is the reduction of negative carry because of higher liquidity maintenance. So that is why you saw little higher NIM expansion this quarter. Probably this will remain at this level, or maybe 20-30 bits may change. Go up in this financial year, and some catch up of cost of borrowing also may impact. So overall, but still it will remain about 12.25% at least for this financial year.
Understood, sir. Understood. And sir, finally, any kind of cap on pricing, either regulatory or competitively, do you envisage that, or do you think you have the flexibility on pricing? If you need to increase it more, you can do it?
Yeah, if there is a cost of borrowing increases, There is no difficulty to pass on the pricing because we are still among the lowest price to the customers and competitive in terms of pricing. And our borrowing cost also probably competitive compared to the industry or somebody. So that's why I think we still have ability to pass on if there is further increase in the cost of borrowing.
Understood, sir. Understood. Thank you so much and all the best for the coming quarters. Congratulations and happy Diwali to you.
Thank you. Thank you. Happy Diwali to you all.
Thank you, sir. Thank you.
Thank you. We have a next question from the line of Puneet Balani from Nomura. Please go ahead.
Hello, sir. Am I audible?
Yeah, audible.
Yeah. Just two questions from my side. First one on the...
Balani, can you speak louder, please?
Hello?
Yes, please go ahead.
Yeah. So just two questions from my side. First, on the ECB mix, you highlighted that it costs, are you able to, including the admin cost, are you able to raise the ECBs and over a near term, say 2 to 3 years, where do you see the ECB mix heading as such?
Sorry, we're not able to hear you properly, sir. Can you use the handset?
No, I think if I understand, Puneet, if I understand correctly, you are asking about the ECB, including hedging cost, what will be our landed cost, right?
Right.
Right. It may be between 9.75 to 10.5%. It may be around 1% more than your normal cost of borrowing, but it will be normally minimum 3 years funding with us. The repayment will start only after 3 years. So therefore, because of the patient form of lending, long-term and stable, even at 1% higher, it will still make sense for us. And this will be with the fully hedged cost.
Okay. And where do you see the ECB mix heading, sir, over the near term?
So our view is, into 2 to 3 years time, overall international funding will be between 25 to 30% of our overall liability side.
Okay.
So it could be ECB, it could be NCD, private base fund. So everything is possible, but looking from the diversification point of view and then the stability point of view. So that mix of ECB and NCD both.
Right. And sir, on the margin front, of course, we've seen you have attributed the reasons on just from an understanding point, what proportion of the book is post FY22? Any color on that? Just to analyze where the differential come from.
Post FY22, you're talking about the disbursement made in these last 2 quarters.
Yeah, but what proportion of AUM is generated from that, as such? AUM is a part of the total because the 90 bits sequential increase. I'm just wondering whether it's because of a high proportion book expiring this quarter or something like that.
No, not because of that. I told the 3 components. I mean, exact components I will not be able to give right now here. It is increased pricing, reduced the delinquency related derecognition when you compare to previous earlier quarters. And the third one is the reduced the liquidity. For example, we used to carry almost 10%, more than 10% liquidity. Now we are around 7% liquidity or 6% liquidity. So it's all these a combination of increase in the NIM. Maybe if you need more details, maybe we can have a one-on-one call with Nilesh sometime later whenever you want. He will be able to give some more color on it.
Sure. Okay, sir. Yeah. Thank you so much. Yeah.
Thank you. Happy Diwali.
Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Nidhish from Investec. Please go ahead.
Thanks for the opportunity, sir. Sir, what is the gross customer addition this quarter, and what is any guidance on that number for the remaining part of the year?
So we already said, Ganesh, you said it's currently our YOY customer acquisition is about customer growth of 8%. And actually, pre-write-off, if you see, it's almost 15%. So, but net actually, we presume that our customer growth will be between 10 to 12%, and the portfolio growth will be over 24-25%.
Sure. 10 to 12% is net borrowing, net customer growth after write-off.
Yeah, net after write-off. Yeah, net customer growth about 10 to 12%, and the portfolio that also net write-off about 24-25%. This is what we guided actually, and then probably we'll be able to meet that without any difficulty.
Sure. And the customers that we are acquiring incrementally, how much are new to microfinance in that?
It's about 30-35% in the first half year. 35% approximately in the first year, the first half together. And it varies between the north and south. Actually, south it may be lesser new to credit. Northern part is higher new to credit. So it's about 30-35%.
Sure. And so lastly, if I look at the competitive landscape, we are the lowest cost provider. We are offering loans at the lowest rate to the customers. But the fact also is that these customers are not very price sensitive. So in this situation, how do we plan to, let's say, gain market share, consolidate position? Because what I see that a lot of players have taken significant price hike and they are offering at 25-26%, while we are still offering at around 20-21%. So that is a significant gap in the pricing that other players are operating at. So how we plan to gain from this?
So our plan is to grow consistently. Market takes on its own. So a customer, working in rural, trying to acquire more new to credit, and then hold them for a longer period is our nature of business, and which we are doing, particularly rural land. So in this process, while customers are not price sensitive, but once they borrow from us, they will start becoming price sensitive, because when they got money from us at a certain price, obviously they will expect the same from whoever the next lender. If not, otherwise they will stay with us. So it will only help us as a competitive edge by pricing lower, and then while borrowing also at a lower price. So I think from a competition point of view, this will help us to gain market advantage. Also, it helps us to retain our clients, which is our main focus. That is why our retention rate is almost 85%. One of the key contributors is low pricing to our customers. So obviously, that actually reflects our nature of responsible lending institution.
Great. Thanks a lot, sir, and wish you a very happy Diwali.
Thank you. Wish you all very happy Diwali.
Thank you. We have our next question from the line of M.B. Mahesh from Kotak. Please go ahead.
Hey, hi. Just two questions. The first one is, so in the market today, we seem to be seeing MFI players and non-MFI players offering multiple number of products, which includes personal loans, individual loans, business loans. How easy or difficult has it been right now to kind of capture the bulk of the data which is sitting there? One, and just more importantly, if I give an MFI loan, does the rule apply as per the current rules? But if I give a personal loan, does the current guidelines apply? How does it work on the ground?
That's an unsecured loan to any low-income household family with less than 3 lakh income and meeting the FOIR within 50%. Will form as a micro-lending as per RBI regulation clearly. So it can be personal, it can be consumption, it can be anything. If it is that forms as a microfinance loan. And I couldn't understand your first question actually. Sorry.
So in that sense, is it easy and difficult? Has it been easy to capture all this data when you are going on the ground?
Yeah, actually it's important element. Your loan officer need to interact with your customers and the family, and then capture all what they do in terms of their business, their income, their expenditure, and the number of people, what kind of business they are into. So we need to train them. That is why, if you remember, we said April, May, we did not discuss too much of money. We spent a lot of time in training our employees how it can be captured on our system, how it can be, popularized, how to train. So we use that time. Of course, you don't have a proper data, but we have to go by proxy and then talking more with the customers. So it's possible to capture and maintain and report to bureau.
Okay. And in that context, do you think loans will go away from given borrowers to other members in the family as well?
It can be. It's a family level borrowing and family level repayment. But
you're not going in that direction right now.
No. It has to be because woman alone will not be running her business.
Absolutely.
Woman is a CFO. Okay.
Sure. Absolutely. Absolutely. Sorry, the second final question from my side is, any other pockets which is still pending from your side where you think the stress on the ground is still not come back to pre-COVID levels?
We don't have any specific pockets actually in our business. We are quite okay. So there are one or two districts not doing well sometimes. It's a normal business when you are operating in 300 odd districts. So otherwise we don't see any difficulties.
Perfect, sir. Thanks a lot.
Thank you. Happy Diwali to you.
Happy Diwali to you too.
Thank you. We have our next question from the line of Viral Chotai from True North. Please go ahead.
Thank you so much. I had 2-3 questions. One on a ESG loan, sir. The question was that you said that moratorium will be there for 3 years. Is there any other conditions also, like spread to be maintained or any other specific conditions which you will have to adhere to obtain this loan?
It is normally bilateral, but we need to really negotiate with respective lenders. There is nothing unique actually. These are the different lenders. So it's like any other bank. It's a unique bilateral negotiation and then the drawals.
Okay. Thank you. Next question, in terms of NCDs, you said will be raised in the next month, maybe in November. What is tentatively cost of borrowing will be there? Because now we got a rating improvement as well. What will be the blended cost for that?
We have not yet decided. We yet to do a roadshow and then meet potential investors, and then we will decide the tenures and the size and the price and the appropriate time before launching the NCD.
Okay. In terms of definition, in our presentation, at the last definitions are given. When I was reading portfolio yield definition, it says interest on loan minus processing fees plus interest from securitization, and in denominator we take average on-book AUM. So when we are taking interest or income from securitization, shouldn't we take a on-book plus off-book in a denominator to arrive at the yields on a portfolio?
I think we follow standard practices, and I think there won't be any difference between standard practice. Therefore, portfolio yield and then the related calculations are equal to a standard practice of any other NBFC MFIs.
Okay. And so last question. I understood most of the competitions or players, we have done extremely well during COVID, and our COVID losses were lowest. So if we take our AUM pre-COVID and we take total credit so far, whatever write-offs including provisions, what will be just a ballpark number? What will be the total COVID losses we would have incurred?
About 4.5% annually for both years.
4.5%. Okay.
2021 on an average of 4.5% both years.
Okay. Thank you so much, sir. Happy Diwali.
Thank you. Happy Diwali.
Yeah.
Thank you.
Thank you. Reminder to participants to press star and 1 to ask a question. We have a question from the line of Shreya Shivani from CLSA. Please go ahead.
Hi, thank you for the opportunity and congratulations for a good set of numbers. So particularly, I have 2 questions. First one is on the borrower count, particularly for Madura. So that has been moderating, and I understand it was supposed to be, it was intended to be this way. So from the coming quarters, are we going to see an improvement in the borrower count over there, or there is still room for correction or culling out of borrowers from the Madura book? That's my first question. And my second question is on this is more to do with the branch discipline or the group meeting discipline, sorry. So as far as I remember that coming out of COVID, a lot of MFI players were reporting that the group meeting discipline has sort of not returned. If you can give us some flavor on how it is now, which states are seeing better recovery, and how much of your group meeting discipline has returned in which geographies of the country?
Okay. In Madura, so we explained the two things. One is because they are handling two types of systems, there will be slight latency in their efficiency in customer acquisition. But the reduction of customer is due to write-off of large number of customers during the last 2 years. If we look at the pre-write-off, Madura also grown by 8.8% in YOY in customers. Therefore, and then portfolio also grow by some 24%, 28%. So it is not that Madura is not acquiring customers, but it is little lesser compared to CreditAccess Grameen. Otherwise, because of the write-off numbers are little higher there, therefore it looks like little 20% reduction in the customers, which we anticipated. So it's still they acquired good number of customers. And then it's improving as right now, if you see 84% of the book is already CreditAccess Grameen platform, only 16% is to be managed now. As it comes down, their ability to acquire more customers will improve. So we will see good improvement in the next 2 quarters in Madura book also. That is first question. Second one is about discipline coming back. I think, discipline was quite good even during COVID, just after that. And when we allowed the center meeting to happen in the system, the discipline was back. We don't have too much of indiscipline in the group. So there's still little attendance reduction while compared to pre-COVID. Probably during pre-COVID was about 78-80% of attendance. Now it is about 70-72% attendance. It is still quite good actually. We don't have any challenge about the group discipline or repayment issues or collection issues. Large extent we are back to normal.
Got it, sir. That answers my question. Thank you, and a happy Diwali to all of you.
Thank you, and happy Diwali to you.
Thank you. Reminder to participants to press star and 1 to ask a question. We have a next question from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Good evening and happy Diwali. I just had a clarification on one of the questions from a previous participant on eligibility of loans. So, sir, you said that if it's below, 3 lakhs and FOIR less than 50%, but this is only if it is under JLG model, right?
Oh, actually, I responded to the regulatory question actually. What is microfinance? I thought for regulatory point of view, it's not ours. Ours is all our income generation loans or the group loans only. Okay.
No, yeah. But for the regulation, my question is that
there is no group requirement. For regulation, there is no group requirement. They not mentioned that.
So even if I want a personal loan, they have to verify whether, I am, of this lower income category and what my FOIR is.
If you want to categorize that under microfinance, then you have to evaluate the family income. It should not be more than 3 years. And you also, more than 3 lakhs. You have to evaluate all the borrowings of the family. And the outflow should not be more than 50% of the total borrowings. So, total outflow. So that has, if you maintain that, it is microfinance.
Okay. Got it. And that is to maintain the 75% share of microfinance to be classified as MFI. That's the only reason.
That is for NBFC MFIs, correct? That's for NBFC. For a bank, for example, not necessarily that rule is applicable, right?
Okay. I got it. That sort of answers my doubt. Thank you and all the best.
Thank you. All the best and happy Diwali.
Thank you. We have our next question from the line of Shripal Doshi from Equirus. Please go ahead.
Thank you, sir, for giving me the opportunity once again. So the question was with respect to the customer overlap. So how many currently, in the for 2Q, what would be the customers which are unique to us, and what would be CredEgg plus one lender and CredEgg plus two lenders?
There is not much change in our customer profile. No, it's about 43% of our customers are unique for Grameen, and about 39% of the customers have one other lender, and the balance have either two or three lenders actually. That's the profile of our customers.
Okay, right. Okay, that's broadly similar. And so the last question was with respect to what is the internal cap on the total leverage that we would be comfortable at the customer level.
So we have taken a call that even though regulatorily there is no cap, we said that if a customer is a vintage customer, if he's already more than 4 years of microfinance experience with us, we go up to 2 lakh rupees of leverage, and if not, it's only 1.25 lakh. That's what we have 1.5 lakh. So that way we took the leverage. It is from all the borrowings together, not just Grameen. So 1.25 lakh is the maximum for the customer more than 6 years with us, and less than various categories from 40,000 to 1 lakh rupees.
Okay, got it. So any color if you could give, what would be the overlap with players like Bhafin and Spanna? I understand there might not be significant overlap in each of the states, but if you could give some color in some of the key states like Karnataka, Tamil Nadu and Maharashtra maybe.
So I will not be able to give state-wise, but overall our overlap with Bhafin is about 14%, and then Spanna is about 4%.
Oh, okay. Got it, sir. Thank you so much, sir. Thank you so much for the detailed answer.
Thank you. Thank you. Happy Diwali.
Same to you, sir.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have a question from the line of Viral Chotai from True North. Please go ahead.
So, more question. In terms of collection efficiency, it's mentioned 98% are IP, and it says it's including arrears as well. So, on a due basis, if you can just tell, and are we reached now pre-COVID level in specific to certain states if they're not doing well?
We said we told both actually. Without arrears, we said 97%. With arrears, 98%. That means demand versus collection is 97%. So largely around the pre-COVID level, because if you exclude the non-paying NPAs, it will be about 98%. That's right.
Okay. And any specific states which are not performing well, where collection efficiency is lower than average?
No, it's overall we don't have too much variations.
Okay. Thank you so much.
Thank you.
Thank you, sir. There are no more questions in the queue. Any closing comments, sir?
Thank you, everybody. During the festival time, we actually took the evening time of all of yours. So, happy Diwali to everybody, and have a prosperous happy Diwali and then new Samvat. Thank you very much.
Thank you, sir. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.